안녕하세요. 한경글로벌마켓을 사랑해 주시는 애청자 여러분 반갑습니다. 저는 김현석의 월스트리트나우를 진행하는 김현석 뉴욕 특파원입니다. 계속되는 긴축의 은행 불안까지 불거지면서 시장이 매우 혼란스러운데요. 여러 가지 궁금한 게 많으실 겁니다. 오늘 네드 데이비스 리서치의 에드 클리솔드 미국 주식 수석전략가를 모시고 여러분들의 궁금증을 풀어보겠습니다. Thank you for being with us. Let's get it started. First question. At the last Fed meeting, the Chairman Powell hinted at the possibility of a final rate hike at the May. Dot plot also suggested the terminal rate at 5.1%. And he said he doesn't expect a cut this year. Do you believe these predictions?
Well, I do think the Fed is getting closer to a pause in the rate tightening cycle. They've done a lot so far, and there have been some signs of economic slowing in interest rate sensitive parts of the economy, like housing. And then furthermore, the regional banking crisis for the last few weeks is likely to result in tighter financial conditions, which would mean that the markets are doing some of the Fed's job for it. So I wouldn't be surprised if maybe there is perhaps one more rate hike and then the Fed pauses for a while, and then we'll see how the economy reacts from there, if they need to do more rate hikes later in the year or not.
Your comment is just similar to the Powell.
Yeah. I think the Fed has taken the right approach, which is they're data dependent, and there are some signs of real resilience in the U.S. economy. The consumer remains quite strong. The lowest 20% of income makers have already spent through their savings from the early days of the pandemic, but the upper 80% still has quite a bit of savings. The unemployment rate is low. Partly because baby boomers have retired, and so the U.S. economy is struggling to fill the millions of job openings as a result. So there are some reasons for the economy to be resilient. So we need to see how it unfolds before making any decisions over the future trajectory of rate hikes.
Will this anxiety related to the regional bank continue?
I think there's going to be anxiety for a while, but each day there's a lack of news on banks running into trouble. I think the market should regain its footing. What's clear is that this is a different type of problem for banks, say, than in 2008, when the value, no one knew the value of those assets. A lot of them are going bad. These are treasury bonds that have gone down in value, but the risk of default is practically zero for U.S. Treasuries. So it's really a matter of holding them to maturity, rather than not knowing what the value of them is.
Good. Is there any possibility that this anxiety will spread to other areas? I think the Wall Street believe that the commercial real estate market is next in line in the wall of worries as regionals tighten lending standard.
Yeah, I think that the real estate market, is slower moving than, say, the public markets where people trade every day. And so while we expect that the commercial real estate market will continue to slow, it's not something that maybe would have an immediate impact. Our bigger concern is lending standards. If they tighten too much, especially a lot of small regional banks, the ones who are at risk of losing deposits, and they are providing loans to businesses throughout the U.S. economy, away from New York and San Francisco and Chicago. And if these banks, stop lending as much, that would have a much faster impact on the broader U.S. economy. So I think lending standards are probably the most important statistic to look at.
Do you think that will happen? The possibility of that will happen is high?
Yeah, I think there's a chance that this is going to calm down and banks will tighten their lending standards some, but not dramatically enough to overcome some of the other some of the strength in the U.S. economy. So will it slow down economic growth? Definitely will be enough to cause a recession. Maybe not immediately. I think our expectations is there's a high recession risk in 2024, but in 2023, the risks are less.
And there are also arguments that the raising rates in May will revive regional bank jitters. What do you think?
Well, the crux of the problem is that banks are not paying enough for depositors to keep their money at the bank. They have opportunities to go elsewhere to earn a higher return. So every rate hike by the Federal Reserve increases the incentive for depositors to move their money elsewhere. What banks probably need to do is just pay a higher rate on the deposits. That the problem is that will hurt bank profitability, but eventually that's what probably banks will do. They'll just start paying more on depositors to ensure that they keep the money at the banks. But another rate hike would make that incentive even greater for depositors to move money.
Thank you. And do you see the possibility of a recession increasing a lot after this jitters?
Yeah, I think it does increase some, but I think the bigger risk are later on this year and early into next year, partly because it takes time for these kind of impacts to flow through to the economy, and also, as I mentioned before, the underlying consumer demand in the U.S. is remains fairly strong, low unemployment rate.
How much possibilities do you for the recession this year? And do you think when the recession will come? When the recession starts?
Yeah, I think our base case is a recession starts in early 2024. I think over the next several months, the odds of recession are fairly low, call them 25 to 35%. But as we move deeper into 2023, in the fourth quarter, they'd increase. And then once we get into 2024, the risks are quite a bit higher.
Have a treasury yield peaked this cycle? Will the 10-year yield rise above 4% again? What level do you expect at the end of June?
Yeah, so I do think treasury yields have, for the cycle, have peaked. As the fears over the banking crisis start to fade, I would think that maybe we would see bond yields start to rise. So the 10-year treasury yield could move back towards 370 or so. But hitting the highs of last year, I think there would that's pretty unlikely at this point.
How about the 2-year?
Well, the 2-year has fallen really sharply in anticipation of Fed rate cuts. So if the economy stabilizes, maybe the market would need to take away some of those rate cut expectations. So again, the 2-year could we could see a rebound of 10 to 20 basis points in the 2-year treasury yield as we price out the rate cut risks short term.
And Chairman Powell said that if banks shrink lending, inflation is likely to fall as employment and consumption slow. And do you still hold the view that inflation will fall in the first half, but not easily in the second half?
Yeah, that's still our base case. There's just some math behind the first half where year-to-year changes will make it easier for inflation to fall. So global supply chains smoothing out are still happening, and then the housing market cooling will bring down inflation. That's a big part of the inflation data series in the U.S. Is housing. So all those things will lead to lower inflation in the first half. But as we move into the second half, some of those factors will start to reverse, and you could see inflation start to tick higher again. Again, not to the 9% that it was last year, but it could remain well above the Fed's 2% target.
Is the housing market bottomed out? In this, some recent data shows that they bottomed out. I'm curious about that.
Yeah, well, I think that interest rates coming down over the last several weeks has re-engaged some buyers who maybe had had been priced out of the market because of the sharp rise in interest rates. So the housing market, I think, will continue to be sluggish and not really additive to growth. But if rates don't spike up higher again, there'll be some people looking for homes still. The bigger issue in the U.S. is that for the past 15 years, there haven't been enough homes built. So there's still a critical shortage of housing.
And while banks are in turmoil, the Fed is providing liquidity again. There are also observations that this can act as a good thing, backstop for the stock markets. Do you agree?
Yes, it is. You know, this what the Fed has been doing is not the same thing as quantitative easing. The mechanics are different, the way they're providing liquidity directly to the banks, but the net result is similar in that there's more money in the overall system for the economy, and some of that inevitably will flow into risk assets like stocks. And so, if nothing else, you know, they're no longer, you know, engaged in outright quantitative tightening, and that's positive. So the Fed adding liquidity, you know, that's bullish for stocks.
Good. And the Fed is expected to stop raising rates soon. How will stock market react in that point? In the past, it has often bottomed out after the Fed cut rates and the recession began. Is the stock market likely to make a lower lows than last October in coming weeks and months? Some argue that for now, stability to build in the banking sector and market in a range-bound, grind-out fashion.
So if you're to go back to the last Fed rate hike since World War II, on average, the S&P 500 has fallen about 5.5% 6 months later. So usually the last rate hike occurs because the Fed broke something and tends to be negative for the market. But if you were to look over the past 5 times, so since Alan Greenspan became chairman of the Federal Reserve since 1989, the S&P has been up at least 10% 4 out of the last 5 times. Now, sometimes the market rallied for a little while longer, like in 2006, the market rallied for over a year and then it peaked out before the financial crisis. It doesn't mean that there won't eventually be a problem, but there is a window for the market to rally if the Fed, once the Fed finishes hiking. So eventually it'll probably be a problem for the stock market. It just doesn't have to be an immediate problem for the stock market if the Fed stops hiking.
Yeah, but I saw last week one of the report from the Bank of America. They said last 5 tightening cycle was in the disinflationary the background. So it is different from the 70s, 80s, and rest 5 cycle. But this time we are in the inflation era, so it will be similar to the 70s. Do you disagree with that?
Well, I think it's a valid point. If you think we're in a higher inflation regime, and really what it comes down to is whether or not inflation expectations get out of control, which is why, you know, our thought is that this is more of a pause and not actually the last hike. Maybe the Fed will have to step back in later in the year and do more hikes to get inflation under control. So in which case, then maybe that study is valid. It's valid for next year, not now.
Right. Okay, I got it. Wow, it's more horrible. Wow. The last earnings season was not too bad either. How do you see the first quarter earnings seasons starting next month? And will there be an earning shock? Some say ultimately the earning impact starts to build throughout the spring and summer month.
So if you look at earnings expectations for Q1, for the first quarter, consensus estimates are calling for only 2% earnings growth. And so that's come down from about 9% a couple of months ago. So analysts have taken these numbers down. But later in the year, second quarter, third quarter, fourth quarter, the consensus estimates are still above 10%.
Right.
So I think that what we need to see are those other estimates come down to be more realistic. And that's going to be the key metric to watch during this next earnings season.
Tech stocks are showing a strong performance, especially some big tech, and some argues that the big tech stocks are the new safe haven. And what is behind this bullish trend, and will this trend continue?
So I think there's a couple things behind this trend. One is that interest rates have come down, and that tends to be positive for tech stocks. The second thing is that tech stocks were, particularly the large cap tech stocks, were defensive during the 2020 bear market because they were able to continue to operate while many other parts of the economy were shut down. So investors are just reacting to what happened last time. But if the economy does go into recession, I would expect traditional defensive sectors like utilities, consumer staples, and healthcare to probably outperform tech. But those are the factors I think behind the most recent move, and there's some good rationale for it. But again, if the economy falls into recession, I would think that other sectors are probably better places to hide.
In short, you're saying it's time to sell the tech? You mean?
Yeah, not at this point. I wouldn't say we'd sell it because again, we don't think a recession risk is imminent. Maybe the better chance to sell would be later on.
Later in this year. Okay, got it. How will the dollar move? And I'd love to hear your views on the oil and gold also.
Yeah, so the dollar is probably going to be a little bit weaker as the market starts to anticipate the end of the tightening cycle. And last year, particularly the first 9 months of 2022, the dollar was extremely strong. So we won't be surprised if that reverses. But gold, I think, could be a positive place to hide for the exact reasons the dollar may be weaker. Oil has already come down quite a bit, so we wouldn't be surprised again as in recession risks of the short-term fade. Oil could bounce some over the next several weeks to a few months.
If the recession come, what's the bottom of the oil? How much do you think?
Yeah, oil could break the recent lows, and oftentimes during recessions, oil falls a lot farther than what people think. So you could see oil prices in the 40s during an economic contraction. So I would expect demand to fall off quite a bit.
Okay, thank you very much. That's all for today. I appreciate your insight and great answers. And thank you for being with us again. See you soon.
Thanks. Yeah, see you soon. Thanks for having me.